Home prices aren't just cooling, they're entering a deep freeze. Zillow has turned outright bearish, slashing its home price growth forecast to just 0.2% for the year. That's effectively flat. And for a housing market that has soared during the pandemic, this is a full-blown reversal. But this isn't just a uniform slowdown. Some housing markets are about to get hammered. Austin, Phoenix, Tampa, Boise, places that boomed the hardest are now the most vulnerable. The cracks are showing, and this time the foundation is affordability. The pain we're seeing isn't just cyclical, it's structural. Mortgage rates are hovering around 7%. Builders are slashing prices, and the spring selling season has flopped, and buyers are simply walking away. If you're still waiting for home prices to come down, you might finally be getting your shot. But if you bought near the peak, you may be facing a few years of slow depreciation or worse, even some negative equity. Let's start with what the home builders are saying. D.R. Horton, one of America's largest home builders, just called this one of the slowest springs in years. And they're not alone. Builders across the Sun Belt are piling on incentives, $50,000 cashback offers, free upgrades, mortgage rate buydowns, just to get contracts signed. In Florida, particularly around Cape Coral or Tampa and Jacksonville, the mood has shifted from boom to bust. Inventory is climbing. Homes are sitting longer, and price cuts are accelerating. Zillow's latest report highlights a significant downgrade in its price forecasts. Some metros are already seeing outright nominal declines. ReVenture Consulting has a lot of great data about this. Cities like Austin and Phoenix are down more than 5% from their recent highs, with Florida and Texas metros not far behind. And these were the pandemic's hottest markets. Everyone moved there for space and sunshine and low taxes. But that demand wave created a price bubble, and now it has nowhere to go but down. Now here's what makes this downturn different. It's not driven by bad lending or credit issues. It's about affordability. More specifically, the ratio between home prices to income. Right now, that spread is historically wide. Home prices have skyrocketed far beyond what local incomes can support. And that's a problem that can't be fixed by 1% price drops or some temporary rate buy down or extra $5,000 off the asking price. Home prices have completely disconnected from income. And that spread is simply unsustainable. In many metro areas, home prices are up 30-40% since 2020, some even more, while incomes have grown maybe 10%, and inflation's grown higher than that. You don't need a PhD in economics to know that the math doesn't math. At some point, either prices need to come down or incomes must go up. And with job growth slowing and inflation still elevated, that income surge it's not coming, which means prices are going to need to do some adjusting. And here's the kicker. Even a small drop in home prices has a massive consequences. According to Redfin, the total value of the U.S. housing market is nearly $50 trillion. And that's up more than $20 trillion since 2020, which is absurd. If prices fall just 2%, that wipes $1 trillion out in household net worth. A 5% drop, $2.5 trillion. And not just on paper, gone from the economy in the form of lost confidence, reduced borrowing, and weaker consumer spending. It's not just a real estate issue. The U.S. economy is now built on asset prices. Home equity is the backbone of household wealth. When that falls, it triggers a chain reaction. People spend less. Businesses feel the hit and they start laying people off. And more homeowners are forced to sell. More listings means more supply, which pushes prices down further. This is how a housing correction turns into a housing crash. Not all at once, but in a slow, grinding feedback loop. Now, ReVenture's forecasts are especially sobering. They're not based on some vague macro trends. They look directly at local supply and the price to income ratio. Very simple. And they're projecting 3 to 6% nominal declines in major metros across Florida, Texas, Arizona, and Colorado. Meanwhile, markets like Columbus, Pittsburgh, and Cleveland, they're projected to see some price stability or even some modest gains this year. Why? Because prices in those markets are still aligned with local incomes, and inventory is a bit tighter, supply and demand. And this highlights a broader trend. America's housing boom was never truly national. Nothing in the housing market's ever national. It's regional or local. The biggest gains are in low-tax, warm-weather states that attracted a flood of remote workers during the pandemic. And those same workers now face oversupply, affordability problems, and buyer fatigue. Florida in particular has become a poster child for this dynamic. Everyone moved there. Prices exploded. And now locals are priced out. And some of those remote workers, they're moving again to cheaper metros with better price to income ratios, or they got forced to return to office. Affordability is not just about price. It's about monthly payment. And right now, monthly payments are at an all-time high. Mortgage payments have doubled for many borrowers compared to just 2021 rates. According to Zillow, the typical monthly payment for a new purchase home is up over 100% since the pandemic started. That's a double. And that alone is enough to choke off demand and leave people struggling. Banks are feeling it too. Loan applications have cratered. According to Yahoo Finance, major banks are now lobbying for looser mortgage rules just to keep the business flowing. And you know things are bad when they're lobbying for looser mortgage lending standards. That's crazy. And that's not confidence, that's desperation. Lenders are trying to grease the system because demand has dried up. If rates stay elevated and prices don't fall significantly, homeownership will remain out of reach for an entire generation. And then there's the tariff wild card. Big surprise. Tariffs on imported construction materials and appliances are injecting uncertainty and raising costs for builders. Higher input costs get passed on to buyers, or projects just get delayed or even canceled. Either way, this slows down supply and gums up the market. Builders can't make the numbers work. And buyers, they can't make the numbers work either. They can't make the payments. Now, what about the argument that prices only need to go down by about 5% to restore balance? It sounds manageable until you realize how inflated values have really become in a lot of areas. Home prices relative to income are not just above historical norms, they're above 2006 bubble levels. It is higher than the last great housing bubble. A small correction from an absurd starting point is not enough. It's probably going to need to be a multi-year grind, or maybe even a sharp drop to bring housing back to affordable levels. Even worse, because the economy is now so dependent on asset inflation, small corrections hit harder. A 5% drop today hits the economy like a 15% drop would have in like 2012. And that's the problem with building your economy on paper wealth. It only works as long as prices go up. When the prices start to go flat or drop, everything built on top starts to wobble. What could make this worse? A recession? If job losses pick up, more people will be forced to list their homes. Most of them have equity, sure, but that only matters if there's a buyer on the other side. And in a high rate, low demand market, listings are piling up. More supply, less demand, you know how that ends. Government intervention could delay the pain and kick the can down the road. We've seen foreclosure moratoriums, stimulus checks, down payment assistance programs, first-time home buyer assistance, blah, 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 blah. Could it happen again? Sure, especially in an election year, but all it does is it kicks the can down the road. It doesn't solve the affordability crisis. It probably makes it worse. It kind of masks it. And the affordability of owning a home goes beyond just the mortgage. Insurance premiums are spiking, especially in states like Florida and California, where there's been a lot of climate risks, which has led to lenders just pulling out or drastically raising rates if the state allows them. Property taxes are climbing as local governments reassess homes at peak valuations. Maintenance costs are up due to labor shortages and material inflation. So even homeowners with low mortgage rates, they're feeling some pressure. The dream of homeownership is turning into a financial grind for many. And that'll further motivate sales as economic conditions tighten up. And don't forget about investors. During the pandemic boom, institutional money poured into housing, even foreign money, especially in the Sun Belt. Entire subdivisions were bought up by Wall Street hedge funds, BlackRock looking for a yield, but now that prices have flatlined and rents are softening, many of those investors are reevaluating their positions. Some are already selling. If institutional landlords begin to unwind their portfolios and scale, especially in overbuilt metros, it could flood the market with new inventory and accelerate the decline. Now, another key dynamic is psychology. For years, the expectation was you buy a house, the value goes up over time. That's it, easy. But that belief fueled a lot of FOMO, bidding wars, and speculative buying. And now the mood is flipped. Buyers are waiting, sellers are nervous, and once expectations shift from appreciation to depreciation, the entire market dynamic changes. Price becomes a moving target. Offers dry up, and sellers have to chase the market down, month after month. And that's emotional. That's the emotional side of correction. It's already playing out in cities like Austin, Salt Lake City, and even parts of California. In the end, it's not just about home prices. It's about what housing means to the U.S. economy. When home values rise, people feel richer. They borrow more. They spend more. They go out to eat more. They invest more. When values fall, even slightly, that engine shuts down. And with the consumer already stretched by inflation, student loans, and tighter credit, housing weakness becomes an economic anchor. The risk here is not just a housing slump, it's a broader slowdown that drags the economy down with it. And based on everything that we're seeing, that slowdown is no longer a possibility. It's the path that we're on. Thank you so much for watching. If you enjoyed this video, please give it a like and subscribe for the YouTube overlords. Thank you so much, and I'll see you next time.